Today we've got Tim McGowan, Fund Manager of Zurich Global Equity Income Fund, who use PM Capital as their investment manager in Australia. Tim, the fund uses a buy-right strategy. Can you explain that so investors that are unfamiliar with that term might just understand what the principle is that you do?
Yeah, sure, Ian. It's non-traditional in terms of we buy an equity position, but we cap the upside through an option strategy to create income.
Okay, so you use options and you get that income. So you're giving away part of the upside. Is that the story? If the stock was to go quite a bit higher, you wouldn't take that, but you take so much. And of course, if that doesn't happen, you take the premium from the option. Is that?
That's correct. The idea of the product, the objective of the product is to create income. So we forego a little bit of the upside in the knowledge that that option premium we collect is paid to an investor by distribution.
Okay, now you're running this across international stocks?
That's correct, and that's where the opportunity is. This opportunity is new to the Australian and New Zealand market. The fund has a 3-year track record, but where the opportunity is volatility is higher, and we can create income from a stock that doesn't pay a dividend yield.
I'll come back to the volatility in a minute, but talking about income, what sort of level of income are you targeting with the funds?
Sure, our target is 8%. We've paid 10% since inception, and that's via quarterly distributions.
Okay, so is volatility your friend?
Volatility is our friend. For investors fear volatility, but some of the great opportunities are created when markets are volatile. And so we combined a stock selection process with some options management. So volatility is the number one input into an option price. So the more volatile markets are, the more option premium we collect, and vice versa.
Global equities, as I said before, they've traditionally had a very low level of yield. They've always seen more growth being more important. So I take it this is why the strategies come into place. And is there anything else you want to comment on how that you use it to create this yield?
Yeah, sure. I mean, here's a fund which objective is to create income from a global equity portfolio. So global equity yields are around 2 to 3%, generally speaking, despite the fact we've got some very strong cash flows and cash balances sitting on some technology stocks, as an example, that don't pay dividend yields. So the objective of this strategy is to pay income. So it becomes an important component of an income model, for example, for a retiree investor who wants lower risk, needs global equity exposure, but also wants the consistency of that income to live off.
You mentioned there lower risk, and I was just going to ask you that if you're getting a global equities that are giving you 1 to 2% yield, yet you're managing to enhance it up to 8%, 8 to 10% reality, that would sort of sound like you've increased the risk. Yet my understanding of the principles of the way you do business, you've actually lowered the risk. Is that correct?
Yeah, that's correct. I mean, statistically, we are doing 2/3 of the risk, almost half of the risk of the benchmark. So investors have this misconception that strategies that are a little bit more complex are higher risk, when in fact, when used properly and managed properly, these sort of strategies actually lower the risk profile of being in global equities.
So now just coming to the actual stocks that you select and you have in your portfolio, do you work on stocks that pay you the highest premium, or do you have a really strong structure around, first of all, finding the stocks that you want to be in? Is this do you use, in your case, part of the PM Capital structure of selecting stocks?
Yeah, absolutely. Any name that's within the global equity income portfolio is subject to the fundamental investment process of PM Capital. So for a name like Wells Fargo, for example, which has a relatively low dividend yield, that's a name we can incorporate in our portfolio from a fundamental perspective. Some of my income will come from that dividend yield, and the additional part, that 8 to 10% in total, some of that we'll receive from option premium. And that's how we incorporate the stock selection of PM Capital.
So just to summarise on that particular point, your yield is coming partly from dividend and the rest from option premiums, correct?
That's correct. Ideally, you have high volatility and high option premium. that doesn't always happen in terms of getting dividend yield and option premium.
When you look back historically and you look at what sort of, if I call it the range of upside and downside, so what would you like to care to comment on how that might look historically?
In terms of drawdowns for the portfolio?
Yes.
Yeah, because we have a lower risk profile, when markets fall sharply, we have more protection in place. So in a period going back to say 2011 when markets were down 14%, we're only down 4%. And the opportunity cost of having that protection in place is at times we also don't get all the upside. So we sit in a narrow range, which we're happy to be because our objective firstly is income, lower risk than global equity market participation.
And do you have any parameters? Do you generally sit sort of 65-35 or something like that?
Yeah, so we're getting 65% of the upside, but only 35% of the downside. And so we can quantify that across different equity environments.
And because you're investing internationally, and obviously this current season there's a whole lot of other things, do you employ in the funds any other protection mechanisms?
Yeah, certainly. We buy protection. So think of it as an insurance policy. We're buying protection at all times on a minimum of 25% and up to 50% over the portfolio. And that means, as I said, we can have lower drawdowns. So the profile of the fund fits certain investors, particularly investors that are kind of non-accumulation phase, who are just kind of happy to live off their capital base but need to have additional protection in place. And that also includes the currency management. We're not taking a strong long-term view on the currency, we're just trying to minimise the risk the currency poses on our income generation.
Which really just about answers my last question, which was going to be, who do you think that this strategy and this particular fund, who's the investor this really suits?
Yeah, sure. I mean, this particularly suits investors that need some growth of their capital, but want lower risk, but certainly need income to live off. So it's a retiree, that sort of investor by nature, who doesn't want to take as much risk as they did 20 to 30 years ago. It also may suit an investor that's seen the equity markets perform strongly over the last year in particular, may want to take some profits and have some more defensive equity exposure.
So with the sort of the emphasis these days on income, yet the need to if you're looking at protection of the buying power of those assets, this sort of strategy fits nicely in the current market.
That's exactly right. So in a strong market, we can produce a 20% return. So you're still getting equity market participation, but you're also getting paid your income along the way. And one of the risks to the market at the moment is how an investor is positioned in regards to where they get their income and where they're getting their yield. And there's a lot of crowded nature to that positioning. And I suppose this portfolio and this strategy has some diversification in that we can create income from Google, whereas a normal investor wouldn't be positioned in Google because there's no dividend yield from Google, there's not a lot of income creation. So because we have this strategy by nature, we're a little bit more diversified. So there's the diversification aspect to this strategy relative to sitting in cash, relative to sitting in high yield assets.
Well, thank you, Tim, because the buy right strategy is something I've been aware of quite a long time. However, it is a complex part of the equation. For most individuals, it's too complex. But when they can work with an expert like yourselves, with Zurich and others, maybe this is something that they can consider. So thank you very much for your time.
Great, thank you, Aaron.